Welcome to Protea Weekly. My name is Zane Stevens. I'm the founder of Protea Financial. It is Tuesday, January 16th. We're halfway through the busy month. January is chaotic for us accountants. I'm in the depth of finalizing month ends, some year ends, starting to see some tax accounts. 1099s are making a move through my system. It has been crazy. But with all that said, today I'm going to step away from everything to do with year end and accountants. And we're going to focus a little bit on business owners. I've been doing weekly newsletters. We've started Protea Weekly, and the idea is to give people a lot of advice. And I had a couple of people reach out to me and say, hey, I know they're not saying it's a recession. I know people are still spending money, but it is tough out there. It is getting very, very difficult. If you follow me on Twitter, X, you would have seen last week I shared a bunch of posts about the difficulties that the wine industry is experiencing at the moment. People have less disposable income, so they're either foregoing alcoholic beverages, trading down, or trading to a product where they feel like there's more value, i.e., same money, more drinks. It's a tough, tough world out there. On top of that, the people who are spending money have moved from drinking at home to going out and having experiences and drinking in those establishments. They're moving the goalposts because they're saying, hey, DTC is the way forward, which it really, really is. You've got to get into people's homes to get them buying from your winery on a regular basis. But a lot of these people now are back at restaurants. A lot of these people are going out and doing activities. They're probably doing it less frequently. And as a business owner, we're trying to figure out, how do we make sure that our product has been chosen? And that's tough. There's a lot going on out there. There's a lot of choices. And generally speaking, it is a crowded market. So what does this create? Well, this creates a situation where, especially this time of the year, winter in the Northern Hemisphere, where wine sales take a hit. It's a little bit tougher to sell alcohol when people can't leave their house because they're snowed in. It's a little bit harder to sell alcohol when it's rainy, stormy, and people don't want to come to your tasting room because they'd rather do activities that are cozy. So it puts pressure on our cash flow. And for many wineries, you will most likely have a bottling coming up in February, March, way before you see pickup from distributors buying your product or your next club shipment. So for a lot of wineries, cash flow should get tight. One of the main tools that you can use during this time, and hopefully you've had it in place for a while, is a line of credit. LOC, you'll maybe have heard it as well. Line of credits can be a savior for many wineries and businesses that go through seasonality where cash flow gets tight. But before we jump into more details about lines of credit, I do want to quickly talk through some of the other options that you might want to use if you need debt or instant cash flow. I'm going to go through them really, really quickly because a lot of them I'm not very, tuned in on, but there might be an option for your business. So I want you to be aware of them. And if there's any of them that is very much of interest to you, share a comment, reach out to me on social media, and we can talk about it in another session. But let's go through it quickly. There's equity financing, right? If you got a bunch of cash, you can put it into a winery, or you can go out and find people to help you invest in your business. You can look at the debt financing. There are 10, bank loans, fixed term loans, lines of credit, which we'll talk about a little bit more detail. You could go to a hybrid instrument. We see a lot of this in the wine space where people who are equity holders come in with debt at a rate that could be converted to equity in the future. This sometimes happens with bigger investment groups. Internal financing is always an option, but we're talking about these difficult times when internal financing is not really the best. But you might want to look at your working capital, look at that inventory. Is there certain SKUs you're not selling? Should we be using them in the future? Should we, be cleaning those SKUs up, getting rid of them? Do we have all inventory that we can dispose of in a good way that doesn't affect our brand, into markets that we normally aren't in, or potentially offshore? You can look at government and institutional financing. Obviously, a lot harder at the moment, but if you got a good tax provider, you can talk about R&D tax credits. SBO loans are expensive, and there are a couple of grant sort of relief programs, especially if you're farming. Reach out there. There is some relief for the flooding and drought for the last few years in California. You could look at trade financing. Factoring is an option, especially if you have distributed invoices that will be paid, but it will take a little bit longer. Factoring is always a good option for some quick cash. It can be expensive. You're going to have to give up a few percentage of that total receivable, but it can help you in the short term. Then look at strategic alliances. Probably a little bit harder when it comes to small wineries, but they're always an option out there. You never know when you can share costs in a shared space. That's a type of joint venture that could reduce the total overhead you're running with your business. You could look at some off balance sheet financing. Operating leases are a way to do that. SPVs, if you're having to replace equipment, instead of going and paying full cash for it or going for a traditional bank loan, you could go and get some financing with that equipment as using it as collateral. You could use some asset-based financing. This is a tricky space. We've been involved in some inventory financing before, where effectively they'll be like, hey, we'll give you 50 cents on the dollar for the value of your inventory at selling price. That's a great deal. Most likely it's going to be a cost price, which is obviously a little bit harder because you have to prove it, but it can be an option. But it generally means you need to churn the cash pretty quickly. It means every dollar sales you're getting in, you're most likely paying out 25 cents to pay back that loan. So it can still put a lot of pressure on your cash flow. And then one that probably doesn't affect a lot of you guys, but if you are doing a lot of offshore, export type deals, or if you're an importer, you could look at foreign exchange hedging. Tricky space. Back in my audit days, I did have a client that made a ton of money that way and then lost a ton of money when it went the other direction. So be careful of that one. I'm not smart enough to do that. So if you're going to play around in that space, get a professional or you're taking a lot of risk. So that's just quickly 10 options. But as we spoke about in the beginning, option number 2 is debt financing. The two main ones that you've probably heard of are bank loans and line of credit. Today, we're going to speak specifically about lines of credit because I do think this is one of those options that is available to most wineries. And I say most because things have got a little bit tougher. I don't know if you guys can remember, but sort of about 13 months ago, the banking world imploded. A bunch of banks got in a bit of trouble. Their balance sheets got a bit skew, and a couple of banks sort of went under. The problem with it going under is all of a sudden people have become way more risk adverse. The banks have made it harder to lend because they need to protect themselves because there's no guarantee that there will be a bailout in the future. So a lot of the time, if you are going to be looking at a line of credit, be prepared that if your current bank's not going to give you the money, if you go to a different bank and get that line of credit, they most likely want you to move all your banking there because they want the deposits to come into their bank. They want the benefit of deposits. Changing banks can be tough, so just something to be aware of. But banks need deposits. They need to jack up their balance sheets so that they can continue to lend. On top of that, interest rates are high. Nowhere near historicals. They're actually sort of around normals at this point. We've just been dealing with historically low. So if you've got a line of credit, there's a good chance you've got a good rate. If you're trying to get a new one or move banks, it's probably going to be a little bit more expensive. Okay, so this is what it is. A line of credit at the end of the day is a flexible loan that's very different from a traditional loan because it gives you availability to credit. It does not lump you with the full amount up front. This is great, right? The benefits of this is that it gives you a bunch of flexibility. You only pull the money when you need it. And a lot of banking institutes, if you're a connected bank, I've seen 24 hours, same day sometimes, but generally about 48 hours, 2 business days to get your money to be able to do it. So you're going to use a little bit of planning, but not having to pay interest on the money that you've got a right to is such a benefit. That big part is, biggest part of it is interest and payments. Like if you've got $500,000, but you're only using $100,000 right now, you're not having to pay interest on the full 500,000. You only have to use interest on the 100,000, pay interest on the 100,000, which reduces the cost of a line of credit versus a traditional loan significantly. So also, if you're struggling with a bank loan and you're going to a third-party private money, be aware they're most likely going to give you money and you have to pay it down pretty rapidly. So line of credits are generally the most friendly when it comes to the cost, even if the interest rate is higher than you're expecting, because you're not having to use it all straight away. The next benefit is most of the time line of credits have an open term. And I'll say most of the time, and be very, very careful on this one. But there is no end to it. Generally speaking, there will be some sort of renewal process. But if you're using the line of credit the way it is needed, most banks will just keep revolving it for you. This is a massive, massive benefit. Okay. There's a difference between secured and unsecured line of credits. And I'm not going to jump into that. I'm not a banker. Maybe I can get one on here one day to sort of talk us through some of the different types of lines of credit. So any of my banker friends out there that want to jump on here maybe next week and we can talk through this, that would be great. But you got to look at sort of terms of that. But here's the thing, right? You've got all these benefits. Availability, lower cost because you're only paying interest on the amount you used. It continuously revolves and it doesn't really have a term out. These are great benefits. And line of credits are in place for a specific reason. They should be used in the short term to help you manage cash flow. So in seasonal businesses are very great. If you're trying to grow your inventory, really good. But the idea is it should be short term. And a line of credit needs to see turnover. So what a bank likes to see in a line of credit is take 100,000, pay 100,000 off. Take 150,000, pay 150,000 off. They want to see ins and outs. They don't want to see you take 100,000 and then just sit there forever. No. Now it's a term loan. You took money up front and you're going to pay me back sometime in the future. Do not like that. I've had clients where that revolution of credit was really important to them. They would look at it on a weekly basis. Hey, we need 100,000 this week. Great. Got a bunch of money in. Let's pay 60,000 back next month. Okay, we back to that 100,000 we need. Let's take the 60,000 again. Back and forth and back and forth and back and forth. And try get it down to zero at some point in the year. Banks like to see that revolution. They want to see that you're using it to manage cash flows rather than to subsidize cash flows. They don't want it to be there all the time. If you use it correctly, you probably have a little bit of freedom. Some of them have covenants and people are going to do some sort of covenant reporting. Generally not a big deal, right? Make sure you have inventory, make sure your AR is getting paid down, don't let your AP grow too much, and generally, let's stay away from other debt unless you're telling the bank, hey, you have priority when we get payment. So those are things just to watch out for. I'd be careful if you're lending it to not show that you're using it to pay yourself. People want you to pay yourself a wage, but if you're taking distributions with your line of credit, that's a bit of a no-no, right? But a line of credit is a small business, and especially a winery that is very seasonal's best friend. A line of credit is something that you should get in place, even if you don't need it. Yes. I say that because you're probably going to need it at some point, unless you're a super successful winery, or if you've got a lot of personal wealth and you have to put it in. But I always recommend a winery go out and try get a line of credit. You never know when you're going to need that tool, and developing that relationship with your bank early is a good idea. It can be used at bottling time when costs are increasing. It can be used at harvest when your costs are up because you've got more people working at your winery. It can be used if you want to grow your inventory. It might even be used sort of, you know, in other cases as well. Hey, maybe you want to bulk buy some glass to reduce the overall cost because you've got space in your warehouse. Go use it. Use that line of credit, pay it, and then pay it back down. Make use of it, pay it back down. Make use of it, pay it back down. They want to see the revolving line, but it is a great tool for you, and it's really important that you have it in place. If you don't have it in place right now, I recommend you reach out to your accountant, have a conversation, then have a conversation with your bank to see if you can put it in place. Do not leave this to the last minute where your cash is so tight that you have to jump to alternatives. There's great things like Shopify loans and Amex loans. Really expensive, and all they do is, hey, every time you take money in through your website, they take a percentage of it. That's a great loan, but if you have it in your books, it makes it very hard for them to give you a line of credit because you've got other debt in place. So rather get the line of credit in early so that you hopefully do not need to make use of these options, these more expensive options, these options that put a dent in your balance sheet and reduce the value of your assets. Rather use this really, really great tool being a line of credit that gives you flexibility and affordability to help you manage the tough cash flow periods. Now, one point for you to consider, and this is always going to be a tough one, and I don't always like to end on a negative note, but if you're constantly in cash flow issues, you probably need to take a deep dive in your business. Are you charging enough? Are you maintaining a cost structure that makes sense? Do you have a market for this product that you've put together? Do people even like your wine? These can be tough decisions, and a line of credit is not going to help you if you're not pricing right, your wine is too expensive to produce, or nobody wants to buy it. A line of credit is a cash flow management tool that'll help you get through high working capital periods within your business. Seasonality effects of cold weather winters. Maybe you only do red wine and your sales drop in the summer as well. Line of credit is a short-term tool to help you manage that cash flow, and it can be a really, really successful tool. Now, I'm no expert. I'm not a banker. This is not what I do on a daily basis, and I know there's different types of lines of credit. But I'm willing to have a conversation with my clients or any other winery out there, and we can then match you with banks that meet your needs, have a conversation with them, and see if a line of credit will be possible. A lot of the time, it's just worthwhile going through the process and having it available and use it the way it's supposed to be, short-term revolving. If you use it that way, lines of credit can be super, super successful. Now, we did start off, gave you 10 options in terms of all the other options. And just to run through them quickly, equity financing, debt financing, spend time on the LOC this week, hybrid instruments, internal financing, government and institutional financing, trade financing, invoice factoring is an option, especially if you've got big distribution program. That is a place where you could get some quick cash. Strategic alliances and JVs, off balance sheet financing, asset-based financing, and the one that I'm a little scared of, foreign exchange and hedging. I'm just not smart enough for that. Lines of credit can be really useful for your business, and it is worthwhile looking into it. So definitely gone a little longer than usual today. I've been aiming for that 15 minutes, been about 16 the last 2 weeks. We're already here at almost 20 minutes. But a couple of housekeeping points. Next week, I will be going live on Monday. That is Monday, the 22nd. And the reason for that is that the 23rd and 24th, I'll be in Sacramento, California at the Unified Wine Symposium. Protea Financial are a proud sponsor of the events, and I'll be out there getting some great education. They have some of the best keynote speaking, and their state of the industry is really amazing as well. So I'll be taking all that in, as well as just taking the opportunity to network. It is one of the biggest events on the wine calendar, so it does get a lot of the bankers, CPAs, attorneys, and then just wineries themselves out there. So it'd be nice to sort of bump into people, talk to people, attend a few events, as well as walk the trade floor and just see what options are out there. I'll definitely be looking at, you know, technology that could help wineries, most likely focusing on the DTC business. How do we sell our inventory? Um, as well as inventory management. Hey, we love Innovant, but it's also good to look what other options out there. Some people just don't like the product, and it's good to have an alternative to your favorites. I'm sure I'll also bump into a bunch of CPA friends out on the floor. I know they like to have a booth there, so I'll bump into them. And I'm sure I'll see a lot of people in the outsourced accounting space as well. It's always good to look into them, see how they're doing, see how we can help them. Collaboration is so important. There's 11,500 wineries that need help out there, and I can't do it all myself. My team can't do it, all as well. So knowing who those people are, knowing who the people are doing a great job, so that I'm able to refer people if I can't take on work or if it doesn't quite match what we're up to, is very important to me. Collaboration over competition is a win-win for me, for them, and for you, the clients. Thank you for spending the morning with me. Sorry I went a bit long, but hopefully I've given you some insight into a line of credit and how it can help your business better manage difficult cash flow periods to help you stay in business and be successful. Until next week, live on Monday. Yes, Monday. I'll see you then. Be kind. Goodbye.